With the best possible insight into this, we're joined by the company's chief executive, David Brennan. So, first of all, your reaction to these figures?
Well, I think we're pretty happy with the performance of our business overall in the first half of the year. It exceeded our expectations, driven really by a few key products, as well as some geographic performance that went, especially in the emerging markets, it kind of got ahead of where we even thought we'd be. So overall, good balance, and we've managed the expense line really well, so we've been able to put a pretty good picture together.
Given the fears that we've been talking about, a double-dip recession, economic slowdown, do you think, what are the obstacles or the difficulties you may face in sustaining this kind of performance?
Yeah. You know, the bigger issues for us, Maryam, are patent expirations and loss of exclusivity on our products. The overall economic situation doesn't have the same kind of impact on healthcare as it has on, for example, consumer goods and things like that. So what we really work on is trying to navigate through some earnings fluctuations and some revenue fluctuations when we lose exclusivity on some products, something that's happening right now in our business.
How severe will those fluctuations be?
Well, we've guided to say that we expect over the 5-year period we're in right now to see revenues between $28 and $34 billion. So that's, there's a range in there, and it really just depends on the significance of the penetration of generics when some of our products lose exclusivity.
Now, two major coups for you this year, winning the Cresta patent trial, and now last night FDA advisors recommending all 4 indications on new potential blockbuster drug, Brilliant. Did these victories surprise you? Were you confident that you would see this result all along?
Well, obviously, when you're challenged, you always have to take stock of exactly where you stand. But we, on the Cresta issue, we have very strong backing behind our intellectual property and our patents, and we felt that that was one we did want to take to court. So we were pleased to win. Brilliant and the advisory committee. This is a new product that's in review. The U.S. is an important market, so to have the advisory committee vote in favor of it is good news. We have it filed in 9 other places. This is a product we'll market globally, and we're excited about because it's a really good medicine.
Now, you've raised your buyback. Why only $1 billion extra for 2010, given the recent good news?
Well, that takes us to $2 billion for the year in the buyback, and that's the best way for us to return excess cash from our business to shareholders, and we increased it because we've seen a better business performance in the first half of the year. We also declared an interim dividend, so I think we see that the capital return structure that we put in place, for our shareholders is pretty reasonable, but it also allows us to make sure that we've got capital available to invest in opportunities that we might see going forward. So it's a balance.
But can your shareholders look forward to more in the future?
Well, we do this on an annual basis. The board looks at the overall operation and performance of the business and makes a decision. And they made the decision based on how our business looked for the rest of the year to go ahead with this. So we look at it for a year period of time, and we'll talk about it again at the end of January when we give our year-end results.
And indeed, speaking about that, you've raised your forecast now for the 3rd time this year. Have you perhaps been too conservative in your assessment of the business?
Well, I think we benefited from, I talked about patent exclusivity, and we had some assumptions around how quickly some patents, some products, generic products, would actually penetrate our business, especially in Europe, although also in the U.S. we've done a little better than we thought. So.
Okay, well, thank you very much indeed. Really appreciate your time.